Hi, I'm Daniel Dobbs, Senior Sales Manager for High Tech Lending in Newport Beach, California, and welcome to my webinar, Credit Restoration. I'll be your host for today's webinar, and please feel free to fast forward, stop, or rewind this presentation at any point. Should you find this webinar of value, I will be hosting other webinars that will be online by January 1st of 2009. For more information or to view the other webinars, simply log on to this portion of our website at hightechlending.com. Are you considering changing offices or brokerages? Then please consider High Tech Lending. We have a lot to offer, most notably 100% commission on each of your deals, less than $750 transaction fee, and because we're a true mortgage banker, there is no yield spread premium disclosure required. For more information, just simply log on and download an employment package at your convenience. If you're listening to the sound of my voice, there's a reason for it. Both of us are long-term survivors of this challenging industry. Currently, the credit markets are under siege, and we need to find a different way to do business. Today's objectives are this. I want you to start thinking about credit as a process versus an event. Your borrower one day will just not wake up with low credit scores. There will be a series of events that bring this into play. I want to show you to the inside workings of a rogue industry, an industry which is not very receptive in working with consumer advocates. I want to develop some strategies for limiting the damage to your credit report, and I want to teach you how to play the game. Credit is an emotional issue. I want to provide you with hard, useful information that you can use right now. So you can sit back. I don't have any books or tapes to sell you, no edgy music to play, or any upbeat, emotional messages for you to listen to. Just hard information that you can apply right now. Let's briefly take a moment to look at the home pages of the three major credit bureaus. If you or your client has bad credit, there are consequences. First of all, your credit line, your home equity line, could be cut off. And if you're late on your MasterCard, your Visa and American Express, as well as all other creditors, can jack up your interest rate to the maximum allowed by law. They'll suffer embarrassment, harassment, loss of security clearances, which are very important if you're in the aerospace industry or you're a member of law enforcement. Lifestyles are lost, marriages fail, kids are uprooted. Higher car and homeowner rates may ensue in the future. Now, charge-offs or debt reduction by any of your lenders are considered income and taxable by the IRS. For example, a $100,000 write-off will place you in a 40% tax bracket, state and federal, resulting in a $40,000 tax bill. Can't pay? You should consider filing BK before the 1099-C, which is the tax form, is issued by your lender. Or simply consider the IRS Easy Payment Program. The IRS will charge you a 19% annual interest rate, that's $7,600 in the first year, until you pay down or off the balance. I wonder, did John Gotti know about the lucrative opportunities working for the IRS? We'll never know, I guess. California law entitles each consumer to one free credit report per year per bureau. When you log on, you'll be steered away from every free service to every fee service on their site. Credit scoring is risk-based. It's a scoring model to objectively evaluate all of the information in your credit file. Each scoring model analyzes and balances the pieces of credit information to assess the risk for repayment of future debt. It's a snapshot in time of your credit file at any given point. It is your financial DNA. Credit data that is analyzed for future repayment of debt consists of the following: past payment history, debt capacity versus debt utilization. Note that if your balances are maxed, your score is lower. This is why you don't cancel credit card accounts despite the fact that you don't use them. Also, the length of credit history and applications for new credit. If you go out and apply for 10 new credit cards today, you can count on your score taking a nosedive. The biggest credit score killers are the following: divorce proceedings. I think we've all had some experience in that. Medical bills, insurance companies, and collection agencies form a perfect trifecta to drive your credit score into the ground. And let's not forget the IRS as well as state taxes. Student loans as well, particularly when the account transfers and payments are made on time to the old servicer but are credited late on the new servicer. Identity theft and identity confusion we're going to cover in later frames. And some of the other silly and senseless reductions in credit score result from small unpaid balances that clients simply blow off thinking it won't matter. Also, don't forget the cell phone and cable services, another group of individuals that are very helpful when driving your credit score into the ground. Let's go into the length of reporting for each item. First of all, bankruptcies. Bankruptcies, despite what people say, are impossible to move from the credit report. And yes, I've seen it happen once or twice, but for all intents and purposes, just figure that it's impossible to remove them. Should your client file a Chapter 7, it's 10 years from the date of discharge, which is typically 6 months from the date they file. On a Chapter 13, it's simply 7 years from the final date of discharge, but the 5-year payment reprogram will take it to approximately 12 years. Judgments are valid for 10 years. They're reported for 7 years. However, in California, they may be renewed for another 10 years at a 12% annual percentage rate. So the initial judgment doubles every 6 years. Also, unpaid tax liens, of course, those are Uncle Sam's, and they are reported indefinitely. Any 30, 60, or 90-day lates or charge-offs are often reported for 7 years. Should you or your client file a bankruptcy, this will be the damage to your credit score. Or, should you have a 30, 60, 90-day late, this will be the damage to your credit score as well. Often, many consumers have problems with their credit reports for very legitimate reasons, in which case it should be rather easy to get a deletion letter from the creditors. These are the highlights: the wrong billing address by the creditor, documented identity theft or confusion that we'll cover later, an account that shows a balance after the account is closed. Also, the creditor agrees to write a deletion letter, simply recognizing their error. One thing that's important, based on my 24 years of experience, I have found that it's not worth your time to dispute lates over 4 years. Even though they're on your credit report, they don't impact your credit score. Here's an example of a deletion letter for the information that needs to be disclosed in order to be valid and to make it for easy removal. Some information in credit reports are accurate but not updated. Let me give you an example. If a consumer loses a small claims court decision, they need to pay the court directly, and in return, they will receive a release of judgment issued by the court. A copy of a canceled check sent directly to the Bureau is not sufficient for the bureaus to show the account is paid. Also, and this is kind of difficult to grasp, so hang on here, a divorce decree removing responsibility for a specific account in a divorce is enough for a mortgage company to recognize it is not a borrower's responsibility. Therefore, if an errant spouse has not paid an account, the account can be removed for the purpose of a mortgage only from your borrower's credit file, therefore, in theory, boosting their score. The 3 bureaus, however, don't recognize divorce or the power of the divorce judge as a reason to rescore, and a mortgage lender does. Got it? In order to raise your credit score, the first thing we're going to do is appeal directly to the creditor. But first, we're going to start by filing a temporary fraud alert with all the bureaus. This forces all of your creditors to verify information, if requested by the bureau, manually with hard copies of invoices at a later date. Most creditors will simply not take the time or have the time. They may be out of business. Start with the easiest credit reporting items first. Bank cards and car loans are very difficult. Save those for last. Department stores, on the other hand, are the easiest because they want your future business. Somewhere in between are medical bills, and it's an excellent chance that they'll remove the item if you deal directly with the doctors and the hospitals. Please remember, keep a conversation log with names, dates, phone numbers, and particularly extension numbers, as you'll be contacting these people probably repeatedly. If you get no satisfaction there, we're going to have to start disputing the 3 bureaus. Once again, we're going to start by filing a temporary fraud alert. This slows down any creditors reporting back to the bureau.